Securing your family's financial future is a delicate balancing act. You must protect against disaster today without compromising wealth for tomorrow. Life insurance gets confusing because it is pitched as two conflicting things at once: a temporary safety net to replace lost income and a permanent investment vehicle to grow your cash. This chart illustrates the exact trade-off in every insurance decision, weighing premium cost against coverage permanence. Many rely entirely on employer-provided life insurance. Since it costs little out of pocket, it drops into the low-cost, low-permanence corner. The problem with employer coverage is twofold. The death benefit is usually far less than a family actually needs to survive, and that coverage vanishes the moment you change jobs or get laid off. Relying on a non-portable default plan leaves your family exposed to a sudden job loss or a change in health. You need a dedicated strategy. Despite the aggressive marketing you might see on television and online, there is absolutely no universal best life insurance policy for everyone. The right choice depends strictly on a realistic assessment of your long-term budget, the people who depend on you, and your specific legacy goals. You have to decide between buying highly affordable term coverage that will eventually expire or committing to expensive permanent coverage that builds cash value over your lifetime. The only way to avoid overpaying or losing coverage when you need it most is matching the mechanics of the product exactly to your current life stage. This line graph charts a 20-year renewable term policy. You secure a massive death benefit for a low, fixed monthly cost that stays completely flat for 2 decades. Term life acts strictly as a temporary safety net. It delivers maximum coverage for minimal cost, efficiently protecting your income while you pay down a mortgage or raise your kids. But term policies build zero cash value. If you outlive that 20-year time frame, the coverage ends, and you get nothing back. Attempting to renew that same policy after the initial term expires will trigger a massive premium spike, simply because you are 20 years older. Term life is highly efficient for targeted timeframes. However, it severely penalizes those who reach the end of their term and unexpectedly find they still need lifelong financial protection. This comparison matrix breaks down permanent cash value life insurance. These are drastically different vehicles designed to last your entire life, but they introduce new layers of cost and complexity. Whole life insurance secures a guaranteed death benefit and level premiums, while slowly accumulating a guaranteed cash value over time. The trade-off is strict. The premiums are drastically higher than term insurance. Failing to maintain those expensive payments risks a policy lapse, wiping out your protection. Variable life ties your cash value to market investments, like stocks and bond funds, offering a higher potential for growth. By choosing variable, you assume the investment risk. Poor market performance can erode your cash value entirely, forcing you to pay higher premiums just to keep the policy active. Universal life offers flexibility. You gain the ability to adjust your premium payments and your death benefit as your income changes over the years. Across all cash value policies, one rule remains constant. Taking unpaid loans or withdrawals against your policy reduces your death benefit and can cause the entire structure to collapse. Permanent insurance acts as a complex financial asset, requiring a long-term capital commitment. It is not a set-it-and-forget-it safety net. It is dangerous to assume that all life and disability payouts arrive completely tax-free to your beneficiaries. This split-screen graphic breaks down the core IRS rule. Generally, the plitzable death benefit paid to a beneficiary is excluded from gross income. It goes entirely to your family. But if the insurance company holds the payout and pays you interest on that money, that specific interest is fully taxable. The trap is even sharper with employer-provided disability insurance. Many people pay those premiums with pre-tax dollars to save money up front. Because you avoided taxes on the premiums, the IRS taxes the actual disability payouts as regular income, exactly when you are injured and need the money most. The structure of how your premiums are paid dictates whether your family receives a tax-free lifeline or a sudden tax liability. This decision tree maps out how to match your specific constraints to the correct insurance vehicle. The protector profile fits young families with standard budgets. They need to maximize immediate protection per dollar spent, making term life the exact right fit. Because term life provides no cash value, protectors must build separate retirement and investment strategies alongside their insurance. The optimizer profile covers mid-career high earners. They seek flexibility as income fluctuates, wanting tax-advantaged investment options through universal or variable life. The legacy planner involves pre-retirees with lifelong dependents or complex estate taxes. They require guaranteed liquidity, making whole life a reliable tool. Legacy planners must be prepared for rigid surrender periods and massive long-term capital commitments to keep those guarantees intact. Rigorously defining your profile ensures you buy a policy built for your timeline, rather than paying for features designed for someone else's financial reality. Life insurance is a vital mechanism for safely transferring immense responsibility to the next generation. It demands precision. Never cancel an existing policy until a new one is fully approved. Changes in your health dictate your premium rates, and a coverage gap leaves you unprotected. Review your beneficiary designations every 3 years. If you have young children, set up a trust rather than listing a minor directly, since insurance companies will not pay out to a child. You cannot avoid financial risk entirely, but with the right policies strictly matched to your current life stage, you can transfer that risk and protect your family's future on your own terms.